Howdy, Team 42. It's your skipper here, Darius to present our macro minute for Tuesday, January 14th, 2025. As always, we'll start with the executive summary from today's leadoff morning note. If you would like to review the analysis supporting these conclusions, as well as what specific changes you need to make in your portfolio to remain on the right side of market risk, you need to be a client of 42 Macro. So today's key macro question is, will President Trump favor Wall Street over Main Street? Our answers are, asset markets are finding reprieve from their recent corrections today amid news that members of President Trump's economic team are studying a gradual rollout of tariffs, which is weighing on the US dollar. The plan, which Bloomberg is reporting as early enough in its development as to have not yet been seen by President Trump, is designed to limit the inflationary impact of tariffs by phasing in tariff increases by 2 to 5 percentage points per month, as opposed to a jump condition to 10 to 20% tariffs on all imported goods and 60% tariffs on all Chinese imports, which President Trump repeatedly threatened on the campaign trail. We feel very confident that significant tariffs will be a core feature of President Trump's agenda, if only as revenue offsets from extending and expanding the Trump tax cuts in the congressional reconciliation process. DOGE is unlikely to find enough spending cuts to render tariffs a quote-unquote mere negotiation tactic, as many in the market are hoping. As such, tariffs will be needed to ensure the reconciliation process passes the Byrd rule in the Senate, which demands no reconciliation bill increases the deficit beyond the 10-year budget window. All told, investors should fade any significant pullbacks in the US dollar, driven by headlines that tariffs will be all bark and no bite. Investors should expect markets to erroneously celebrate this kind of wishful thinking when the positioning cycle is in as extreme of a bullish condition as it is currently. Transitioning to our 42 macro dashboard, as always, a wrap up with the questions from our community. This one's regarding rate cuts and pricing. It says, Darius, I've heard all year that the market had some odd number of rate cuts priced in, sometimes 7, others 9. Recently, I'm hearing there's only one cut priced in. That is correct for 2025 and 2026. How do market analysts know how many cuts are priced in? What are they looking at to know how many are expected? Is there a science to this? Or is this merely opinion from talking heads? No. So there is a real science to this. So obviously, if you look at Fed funds futures, you can see what the implied yield on Fed fund futures are at various durations across the curve. You can also look at what we like to look at are overnight index swaps, which are sort of locking them in. It's sort of looking at it from a different angle. It's locking it in across various durations. So as opposed to looking at a December 2025 Fed funds future, you could be looking at a 12-month forward overnight index swap and kind of calculating the spread relative to the existing policy rate that way. So there is science to this. You can actually quantify this. Obviously, you're not going to be able to find data on overnight index swaps without having like a Bloomberg subscription. I believe the CME has Fed Now, so you could actually look at what's priced in from a probability perspective in the Fed funds futures curve specifically by looking at their Fed Now model, but you won't be able to look at overnight index swaps. Investors, I know some other investors look at SOFR futures as well, but I don't find that to be as valuable just given the lack of long-term time series. So we'll wrap it up there. Darius Dale presenting our January macro minute today for Tuesday, January 14th, 2025. Everyone have a wonderful day out there. Best of luck. We'll catch you back here tomorrow. Cheers.